Okay, let's dive right in. Welcome to today's Explainer. We're looking past the daily market noise today to unpack a silent regulatory earthquake happening right under our noses. It's actually far more important than those interest rate cuts everyone is constantly obsessing over. While the masses are glued to inflation stats, there is a massive structural change unfolding that's literally going to reshape the financial sector for years to come.
Section 1. The interest rate illusion.
Right now, financial markets are holding their collective breath, right? They're maniacally tracking every single data point to guess exactly when the Fed might cut rates. But honestly, that's an illusion. It's a total distraction. While retail investors are completely fixated on rate cuts, a radical revision of the Basel III regulations is silently breaking a 15-year regulatory chokehold on U.S. banks. This is a direct trigger. It's going to reboot the U.S. credit cycle, and it will happen regardless of how strict the Fed's monetary policy looks on the surface.
Section 2. The 2008 regulatory trap.
To really grasp the magnitude of this quiet revolution, we've got to understand just how tightly the vice was gripped in the first place. Think of it as a financial straitjacket. Regulators forced banks to hold a massive safety cushion for every high-margin loan they issued, which artificially suppressed their profitability. Ever since 2008, every single asset got run through this incredibly rigid system of risk coefficients. The absolute most profitable tools for banks, commercial loans, credit cards, they were slapped with the highest weight. So if a bank wanted to issue one of these loans, they had to freeze a colossal amount of their own money just as insurance. The result? Banks were forced to park billions of dollars in essentially unprofitable treasury bills or just let it sit dead in Fed accounts.
You can see how this pressure built up over time. It naturally stems from the 2008 crisis, and it just kept building until it reached a terrifying proposed peak in the 2023 draft rules. But then, a sudden, dramatic release in March 2024, which finally culminated with the end of the public debate phase this past June.
Section 3. The Great Basel III Pivot. Now look at this number, plus 16%. That is a terrifying figure. The initial 2023 draft proposed hiking capital requirements by an average of 16%. That would have absolutely crushed bank efficiency. It would have completely destroyed their ability to direct liquidity into profitable channels. And really, this is exactly why Wall Street's profitability and market valuations have been under such heavy pressure for years now.
But then, instead of tightening the screws even more, the Fed's new endgame reproposal dropped, and it shocked everyone. They proposed a 4.8% cut to base reserve requirements for the major players. When this was officially published on March 19th, it essentially just rewrote the table of risk multipliers. Just think about that for a second. The physical volume of bank deposits didn't change at all, but the paperweight of those assets in the eyes of regulators, it suddenly shrank. So banks no longer have to freeze all this cash in low-yield reserves.
And because this mandatory 90-day debate period just wrapped up on June 18th, without any of the fierce resistance we saw last year, by the way, the market is already aggressively pricing in this massive release of capital. The ink isn't even dry yet. The Fed just needs to formalize the text now. Legally, sure, the rules go into effect later, but you know how it goes. The market always trades the future. Investors are baking this inevitable capital release into asset prices today. They aren't waiting around for the final bureaucratic green light.
Section 4. The Double Macroeconomic Blow.
This bureaucratic rule change, it's not just a win for a few bank CEOs. No, it acts as a massive, autonomous motor for the entire U.S. economy. As banks free up these billions, they can issue significantly more loans per dollar of their own capital. That surge in consumer credit expands the M2 money supply. And here's the crazy, ironic twist. Injecting all these fresh loans into the real economy supports consumer demand, which practically guarantees that inflation is going to stay stubbornly high, despite the Fed's strict monetary policy.
Section 5. Wall Street's biggest winners.
So, what does this actually mean for your portfolio? Who are the ultimate beneficiaries here? Well, American banking mammoths have historically traded at a massive discount because of all this regulatory suffocation. But freeing this capital could easily drive their conservative PE multiples up by 2 to 3 points. Right now, the industry average price-to-earnings ratio is hovering around a very modest 12 to 15. Against the backdrop of an overall overheated market, that is incredibly conservative. Easing these rules means the leash is officially off. The efficiency of their assets goes up, which generates pure profit and skyrockets the fundamental value of the business.
And here is the hit list. These specific banking giants are perfectly positioned to redirect those freed up billions into high-margin lending and trading. We're talking about the absolute primary beneficiaries of this structural shift, the heavyweights that actually have the infrastructure in place to deploy this newly found capital immediately.
Let's drill down into exactly how they win. JP Morgan extracts maximum benefit as the most capitalized institution out there. They're taking the cream of the crop from the smoothing of systemic surcharges. Then you've got retail giants like Bank of America and Wells Fargo. They are going to see their margins soar thanks to relaxed risk assessments, specifically on mortgages and consumer loans. Citigroup? They get free fuel to accelerate their massive internal restructuring. And of course, the investment titans, Goldman Sachs and Morgan Stanley, they're going to see massive gains from the lowered requirements on their trading operations.
So here is the ultimate takeaway. This regulatory unchaining creates a massive midterm opportunity for Wall Street. But it leaves us with one really critical, lingering question. Will this new lending boom outpace the very inflation it helps sustain? A rising PE multiple alongside a credit boom holds colossal growth potential for these banks over the medium term. But those ripple effects on inflation, that is what makes this a truly historic shift. Thanks for joining me on this explainer. Definitely keep this dynamic on your radar because this is the real story driving the markets right now.